We left off with slide 22 last time. This is just a review of the depreciation of property, plant, and equipment and what you need to know. So you can pause this, take a look. I suggest you print this out or at least record it. Maybe you already have it committed to memory. The residual value, also known as salvage value, scrap value, trade-in value, those are other names, is an estimate of the value the company would recover from disposal of the asset at the end of its useful life. The cost of the asset less that residual value is referred to as the depreciable base or the depreciable basis. This is the amount that can be depreciated. An asset cannot be depreciated past its residual value. Once again, here they're just refreshing your memory of what you need to know. Now, the useful life of a plant asset is the estimated years that the asset will produce, or the number of units that the company expects the asset to produce. And the number of units refers to the number of items produced, the number of miles driven. It is something that can be quantified. Once again, here's the review. All right, there are 4 depreciation methods: straight line, SL, units of production, ULP, double declining balance, DDB, sum of the years digits, SYD. Now, the last 2 methods are referred to as accelerated methods. So double declining balance, sum of the years digits are accelerated methods. They yield a higher depreciation expense, a higher depreciation cost in the early years, and then it tapers, the depreciation tapers down to where it is less in the later years. However, do take note that each method results in the same amount of total depreciation over the life of the asset. Now, if we look at straight line depreciation method, the straight line depreciation expense can be computed directly by taking cost less the residual value divided by its estimated useful life in years. That will yield the annual depreciation expense. Now, in the numerator in the top, cost less residual value is the depreciable base or depreciable basis. Straight line can also be computed by calculating the annual depreciation rate. To express it as a percentage, then take and multiply that rate or percentage by the depreciable base. So we could take 1, divide it by its estimated useful life in years, and that will give us the annual depreciation rate as a decimal numeral, and then we can convert it to a percent. Here's an example. Patco purchases equipment for its business that costs $25,000. Patco estimates that the equipment will have a useful life of 6 years and a residual value of $1,000 at the end of its useful life. So the formula is to take cost less residual value, divide by estimated useful life, and that will equal the annual depreciation expense. So the cost is $25,000 in this case. The residual value is $1,000. And the estimated useful life, 6 years. So $25,000 less $1,000 will yield $24,000 as a depreciable base. Divide by 6, and that's $4,000 annual depreciation. So each year, Patco records the adjusting entry that debits depreciation expense for $4,000 and credits the contra asset account accumulated depreciation $4,000. To take a look at the T accounts, how this will work. The equipment has $25,000 on the debit side. The depreciation, the accumulated depreciation, year 1 is $4,000, year 2 $4,000, year 3 $4,000. So at the end of 3 years, the accumulated depreciation is $12,000. Therefore, the book value will be to take the equipment at cost at the end of year 3, $25,000. Cost stays the same. less the accumulated depreciation of $12,000, and the net equipment value or the book value is $13,000. Now, in the year of acquisition, an asset may very well be depreciated for only part of the year. Unless an asset is acquired within the first 15 days of the first month of the fiscal year, you will have to prorate and do a partial year. If it is acquired, if the plant asset is acquired within the first 15 days of the first month of the fiscal year, then you can take a full year's depreciation. So, when you have to prorate that first year, GAAP, generally accepted accounting principles, allows the use of any reasonable, consistent method to do the prorating. One method is based on months. Acquisition on or before the 15th of a month counts that month as a full month. Acquisition after the 15th of a month, you do not count that month. You begin the depreciation the following month. So if an asset is acquired January 14th, you count January because that's within the first 15 days of the month. If it's acquired January 16th, then you do not count January. You would start your depreciation with the beginning of February because January 16th is the last half of the month of January. Here we have an example. Nuco purchases a press. The estimated useful life is 5 years. Cost is $17,000. Residual value $2,000. So once again, substituting into the formula, cost $17,000, residual value $2,000, subtract, that's $15,000 depreciable base, divide by 5 years, the estimated useful life, and we have $3,000 annual depreciation, and 3,000 times 5 is 15,000, which is the depreciable base. All right, scenario A. The press is purchased March 12th. Well, because the asset is acquired on or before the 15th, within the first 15 days of March, then Nuco gets to count the entire month of March for depreciation purposes. So March, if we're looking at a calendar year running from January 1 through December 31st, we're starting with the beginning of March, full month of March, and counting through December. That will be 10 months out of a total of 12. So the fractional proration is 10/12. So we're going to be able to take the $3,000 annual depreciation times 10/12, and that's $2,500. We could have taken $3,000 divided by 12, get it on a monthly basis, and that would give us $250 a month and take it times 10. So that would work as well. All right, scenario B is that the press is purchased July 17th. So it is purchased after the 15th of the month. So we're not going to get to count July. We'll have to start with the next month, August. So we'll be counting from August through December. And August through December will be 5 months, 5/12 of a year. So take the 3,000 times 5/12, and that's $1,250. Or like we did before, 3,000 divided by 12 is $250 times 5 is still $1,250. So that first year we would have $1,250 in depreciation, and then for the year after it would be the full $3,000. All right, we have a depreciation schedule that you need to be familiar with. They also have these in the textbook. They give you ones that are filled out that you can follow along and study as examples. They also give you some blank ones that you can write on or you can make a copy of and use it. All right, looking at the depreciation schedule, look at the headings. We have the kind of property, the date acquired, the method, because we've got 4 different methods. We've got the rate that we can express as a percent or life in terms of years. We have that depreciable base, which is the cost less residual value. You have the residual value. All right, so we have all of this information. Here you can see that the property is being filled in over on the left of the screen. You've got office building, land, warehouse, land for warehouse. They have equipment grouped together, clustered, boiler, air filter, vehicles, Chevy Nova, Oldsmobile, delivery van. So they're clustering them. They're grouping them according to the type of assets. And this is the way that they would also tie in with our assets, where we have an asset, a plan asset showing for equipment, a plan asset for vehicles. So that the vehicles would include all three of these types of vehicles in one account. All right, now land is included on the schedule even though it is not depreciated, because we want to be able to track all plant, property, and equipment in one place. So keep that in mind. We will not depreciate land. It's still listed here. So look at the rest of this. They filled in all the data acquired. The SL is for straight line. The two lands have N/A for not applicable. And they have, over under office building, it's showing us 30 years, whereas under warehouse, it's 4%. So they've got a mixture there as to a percentage rate or the number of useful years. The depreciable base then is in the next column, and the residual value. So that the total cost of that office building on that line 1 is the depreciable base, $300,000, plus the $100,000. So it's $400,000 total cost. And these are the figures that we need to calculate the annual depreciation. So, for example, annual depreciation on the office building is $300,000 because that's already the cost less the residual value. That's the depreciable base, and we divide it by the 30 years, and that will give us the depreciation. So, do take note here that what they have blocked out in blue, the depreciation in prior years, we'll need to have an amount in here unless this is the first year of operation. So in this case, depreciation in prior years, they're showing that there was already $90,000 taken prior to the current year that we're looking at. So $90,000 is already showing up in accumulated depreciation. Now, the warehouse and the Chevy Nova that are highlighted in blue, these two assets are fully depreciated. If you take a look there at the warehouse that was acquired on 11/12/72, the depreciable base is $90,000 and the depreciation in prior years is $90,000. So that's why it's already fully depreciated, because the depreciable base equals the depreciation prior years or the accumulated depreciation. Same thing on the Chevy Nova. We still keep them on the depreciation schedule. They will remain until they are disposed of. Then we add another column, depreciation for Y/E, year ending 12/31/2009. So this is for the current column. Let's go back and look at that office building. $300,000 depreciable base, divide by 30 years, gives $10,000 for the year. They've done that for the boiler. If you take a look at $75,000 divided by 15, or $5,000. Air filter is $88,000 divided by 8, or $11,000. The Oldsmobile is $18,000 divided by 6, or $3,000. The delivery van is $20,000 times the percentage rate of 20%, or 0.20, which is $4,000. Now, the last column is for the accumulated depreciation, which means we need all the depreciation that has been taken in prior years, plus the current year depreciation. So we're going to be adding two columns. Look there at office building where the depreciation in prior years, $90,000 plus $10,000 equals $100,000 at the end of 2009, 12/31/2009. And they've done that for the remainder of these. The warehouse, they just simply brought it over as 90. There was nothing to add to it. The boiler is 40 plus 5,000, or 45,000. Again, a word of caution here. You have to look at the depreciable base. You cannot have accumulated depreciation that is greater than the depreciable base. It can be equal to it, but not greater than. The delivery van, for example, at the very bottom, the accumulated depreciation now on 12/31/09 is $20,000, which matches the depreciable base. So at the end of 2009, the delivery van is fully depreciated. Now, well, let me pause here, and we'll come back to this in just a little bit.